Hi, welcome to this special report on outperforming mutual funds with Dr. Ken Long's monthly asset allocation systems. My name is Bill Scheid, and I'm an instructor at Dr. Ken Long's OWL Group, and I've also been trading Dr. Ken Long's monthly asset allocation systems for almost 2 decades. In this special report, we will look at how it's possible to outperform mutual funds and the markets in general using 2 tried and proven market concepts, momentum and moving averages. These concepts are the cornerstones of Dr. Ken Long's monthly asset allocation systems and have been thoroughly researched in the academic literature. We will review the definitions of these concepts, we'll talk about how Dr. Long applies them in his systems, and look at the results that we generate. The first concept that we're going to look at is momentum. We'll look at what is it, how we apply it, and what are the results. So what is momentum? Well, to oversimplify, momentum is the capacity for a price trend to continue. It can be helpful to think about the relationship between the concept of momentum in the world of physics and the concept of momentum in the world of finance. In physics, momentum is a quality possessed by an object in motion and is a product of the size and speed of the object. This connects to Newton's first law of motion, which states that objects in motion tend to stay in motion. In finance, momentum is a quality possessed by a market in motion and is a function of the size and speed of the trend. The idea here is that markets in motion tend to stay in motion. This connects to the market belief that the trend is your friend. Momentum is a concept that allows investors and traders to profit from the herding behavior of market psychology. The concept of momentum has been tested in the scholarly market literature and is an academically rigorous concept. You can see the research done by any of the authors here, including Dr. Ken Long himself and numerous other traders in Dr. Ken Long's Tortoise community and the OWL Group. So how do we apply momentum? Our BMR and momentum-based monthly asset allocation systems are powered by the concept of momentum. In these systems, momentum helps us in a number of ways. So we use momentum to identify and quantify trends across the world's major markets. Momentum gives us the ability to allocate portfolio assets to the world's best performing markets, which leverages the herding behavior of market psychology and allows us to profit from trend continuation. What kind of results can we generate with the concept of momentum? We're looking here at backtest data for 2 momentum-based monthly asset allocation systems. On the right in green, the first column is a standard out-of-the-box system that's very similar to the first generation BMR systems taught by Dr. Ken Long for the last several decades. The second column in green is a second generation system that adds optional volatility stops and short positions. On the left in tan, the first column is the buy and hold performance of the S&P 500 and the buy and hold performance for a globally diversified buy and hold portfolio comprised of 60% stocks and 40% bonds. For the first 5 metrics, total return through ending balance, we see that the standard first generation configuration of momentum system beats the S&P on all metrics. We see that for this period the S&P returned 323%, while our standard first generation configuration of momentum system returned 693%. While the S&P had a maximum drawdown of minus 52.3, the system had a maximum drawdown of minus 34.3. The S&P had a compounded annual growth rate of 9.5%, while the system returned 14.2%. The S&P had a return to drawdown ratio of 6.2, while the momentum system had a return to drawdown ratio of 20.2. Ending balance uses a hypothetical starting balance of $100,000 and assumes 16 years of growth at the given CAGR. And for the S&P, our 100,000 turns into 427,000. For the system, our 100,000 becomes 838,000. The expectancy of the system is 0.38 and the SQN is 3.31, which by Dr. Van Tharp's definition makes it an excellent system. When we add the optional second generation volatility stops and shorts to our momentum-based system, the numbers get even better. Return jumps to 960%, maximum drawdown gets cut to minus 15.7%, the compounded annual growth rate jumps to 0.4%, and return to drawdown ratio triples to 61.1. Here, our hypothetical 100,000 turns into 1.4 million. The expectancy becomes 0.5 and the SQN is 4.05, again, making it an excellent system by Dr. Van Tharp's definition. The second Dr. Ken Long concept we're going to look at is moving averages. And again, we'll look at what are they, how do we apply them, and what are the results. So what are moving averages? In their most simple form, moving averages are a mathematical mean of a set of price data over a specific number of bars. There are several benefits and uses of moving averages. They smooth price data by creating a continuously updated average price. They can be used to identify a trend. They can be used to classify market type. They can also be used to determine support and resistance levels. And moving averages, of course, are a very common indicator used in technical analysis, with the 50 and 200-day moving averages being widely used and generally considered to be important trading signals. The concept of moving averages has been tested in the scholarly market literature and is also an academically rigorous concept. For more, you can see the research done by any of the authors here, and of course, including Dr. Ken Long himself, who has used moving averages in his work for decades. How do we apply moving averages? Our portfolio moving average monthly asset allocation systems are driven solely by the concept of moving averages. They are very simple systems that generate powerful results, and in these systems, moving averages help us in a number of ways. We use moving averages to assess market conditions across the world's major markets. We allocate assets to the global markets with the most favorable conditions. We avoid major bear markets, and we do that while capturing long-term trends and avoiding market noise. What kind of results can we generate with the concept of moving averages? Here we're looking at backtest data for 3 portfolio moving average monthly asset allocation systems. On the right in blue, the first column labeled PMA low is a system that we built for the objective of conservative growth with lower drawdowns, with the goal of outperforming the 60-40 buy and hold approach. The third column labeled PMA high is a system we built for the objective of aggressive growth where higher drawdowns are acceptable. And the column labeled PMA medium was built for the objective with medium growth and medium drawdowns. On the left in tan, the first column is the buy and hold performance of the S&P 500, and the second column is the buy and hold performance for a globally diversified portfolio comprised of 60% stocks and 40% bonds. Here we see that PMA medium and PMA high both outperform the S&P 500 on all of the first 5 metrics in the left column. That would be total return through ending balance. And you'll also notice that while they beat the S&P on all 5 of these metrics, they do it on a lower maximum drawdown than 60-40 buy and hold, which is phenomenal. These two also have an excellent SQN with scores of 4.02 and 3.39, and they have expectancies of 0.36 and 0.34. PMA low was designed to beat 60-40 buy and hold, and PMA low does beat 60-40 buy and hold on all of those first 5 metrics. Plus, it also beats the S&P in terms of maximum drawdown and return to drawdown ratio as well. It has a good SQN of 2.85 and an expectancy of 0.26. So in summary, we see that even though these systems are very simple, because they are based on the concept of moving averages, they achieve excellent results. If you'd like more information about either of these concepts, or the home study courses we offer to learn the systems that employ these concepts, please get in touch at any of the coordinates you see on your screen. This is Bill Scheid. Thank you very much for watching, and happy investing.